Wall Street has just secured its longest winning streak since late 2023. The Dow Jones Industrial Average crossed the 50,000-point threshold for the first time in history, wrapping up an 8-week run of uninterrupted gains. The Volatility Index, or VIX, tumbled over 9%. While these indices appear tranquil, high-volume transactions reveal a significant shift in how institutional portfolios are being structured. This dual-axis chart shows the current divergence. The rising line tracks macroeconomic conditions, defined by high yields and sticky inflation, while the elevated line shows broader indices currently supported by corporate micro-earnings. To understand the sustainability of this trend, we need to trace the physical capital flows. This involves deconstructing the recent oil shock, the resulting movement in the bond market, the Federal Reserve's hawkish pivot, and where institutional capital is rotating. Success in this environment depends on identifying the specific physical assets currently attracting institutional capital, looking past the headline Dow price. The shift began at the edge of the Persian Gulf, where military tensions between the US and Iran reached a critical point. That geopolitical friction immediately impacted energy markets. Crude oil prices showed extreme volatility as traders assessed physical supply constraints, with prices settling at $97 by the week's end. This visualization shows how that energy shock moves through the economy. Rising oil costs forced the Cleveland Fed's inflation projection tool to price in a 6.89% annualized quarterly CPI. Confronted with the raw data suggesting a sudden return to nearly 7% inflation, the Treasury market responded aggressively. The policy-sensitive 2-year Treasury yield rose to 4.14%. Corridor, effectively removing expectations for near-term accommodation. The impact of this yield spike is visible in the real economy. The University of Michigan Consumer Confidence Index fell to a low of 44.8. This decline in sentiment is tied to rising costs at the pump. The workforce is currently absorbing a significant retail gasoline tax, impacting their daily cost of living. The spike in Treasury yields reflects a rejection of previous inflation narratives. The bond market's movement has limited the Federal Reserve's policy options, forcing a more restrictive stance. Facing this market response, the Federal Reserve shifted its tone. In a rapid transition, Kevin Warsh was sworn in as the new chairman, while Governor Christopher Waller delivered a restrictive speech in Frankfurt. Waller explicitly advocated for removing the easing bias from policy statements. In response, interest rate swap markets erased expectations for rate cuts in 2026, shifting toward a higher-for-longer model. High-valuation technology stocks remain stable through this yield spike, which requires an examination of the micro-fundamentals acting as a buffer. The first layer of support is corporate cash generation. NVIDIA reported first-quarter revenue of $82 billion, up 85% year-over-year, alongside an $80 billion stock buyback. This scale of cash flow provided a significant counter to the pressure from rising yields. A political catalyst provided a second layer of support. Following executive lobbying, the White House halted an executive order that would have imposed new regulations on frontier AI development. This shift in policy impacts capital expenditure expectations. Technology companies can now move forward with infrastructure buildouts without the immediate risk of government approval. The combination of monopolistic cash flows and the release of capital expenditure expectations provided a structural counterweight to the high-yield environment. With interest rates remaining elevated, capital is rotating. Portfolio managers are shifting away from pure software plays and toward physical monopolies with high pricing power. NextEra Energy's $66.8 billion acquisition of Dominion Energy secures its control over the physical electricity supply powering Northern Virginia's data center alley. The growth of large-scale AI infrastructure is now constrained by the electrical grid's physical capacity. By securing these long-term baseload power agreements, NextEra locks in rate-regulated cash flows. These revenue streams are protected by utility frameworks, making them less sensitive to Fed interest rates. NextEra is currently trading under a standard acquirer penalty, which has temporarily lowered the stock price. The tactical entry point for this position is at the 50-day moving average, as arbitrage selling pressure diminishes. In a stagflationary AI arms race, the primary source of alpha lies in owning the monopoly on the electricity required to run the models. Another essential defensive layer exists at the hardware level. Keysight Technologies functions as the mandatory inspector for AI hardware deployments. Keysight's second quarter results showed a 56% increase in orders for data center network verification. This chart illustrates their technical position. Regardless of which chip architecture succeeds, the hardware must pass through Keysight's signal integrity verification before it can be deployed into a production data center. The hardware cycle is accelerating. The dismissal of legal challenges against OpenAI clears the way for a potential $1 trillion IPO, forcing competitors to accelerate infrastructure spending. Regarding tactical execution, the optimal setup involves waiting for the stock to retrace and test the upper boundary of the recent earnings gap, targeting a 25. Their technical monopoly and pricing power allow them to maintain margins despite inflation across the AI hardware sector. Stagflation heavily impacts traditional retail. As oil prices rose, Walmart's margins declined. Fuel and logistics slashed profits by $175 million, dropping the stock 7.21%. Capital is therefore rotating into counter-cyclical models like Ross Stores, whose flexible supply chain thrives when economic conditions strain. With consumer confidence at a low of 44.8, the trading down effect is visible. Households are increasingly moving away from department stores and toward discount retailers. The data reflects this shift. Ross reported a 21% increase in total revenue and a 17% rise in comparable store sales. The tactical setup involves waiting for a broader market pullback driven by central bank rhetoric. An entry point develops when the stock tests its moving averages on low trading volume. Navigating stagflation involves investing in companies engineered to convert consumer distress into market share expansion. The recent 8-week market rally is supported by micro-earnings and deregulation, positioned against a background of stagflationary pressures. 3 catalysts will test this structure. First, the U.S.-Iran negotiations in Sweden. Failure in these negotiations could lead to oil breaking back above $100, which would remove the current support for equities. Second, the upcoming core PCE inflation data. Any upside surprise will likely cause bond traders to price in rate hikes, impacting equity valuations. Third, policy friction within the Federal Reserve. Potential disagreement between Chairman Warsh and former Chair Powell creates risk ahead of the June FOMC meeting. Institutional strategies are currently prioritizing hard infrastructure assets, monopolies with pricing power, and counter-cyclical retail. For more deep-dive U.S. stock and market analysis, remember to like, subscribe, and share Calling Monster Finance.